In this week's market update, Europe is investors' main focus as the ECB lines up further stimulus. Brexit follows close behind after a chaotic week in Westminster, and shares hold their nerve as trade worries ease. Brexit has been all-consuming for a domestic audience over the past week, a period of unprecedented drama in Westminster. But for global investors, it's probably not the big event of the week. That accolade goes to Europe, where the European Central Bank is getting ready for another big stimulus as key economies in the region, like Germany, head towards recession. The ECB's policy meeting is due to conclude on Thursday, with officials widely expected to cut interest rates even further into negative territory and to lay out plans for other forms of stimulus. Mario Draghi is due to step down this autumn and might want to go out with a bang as he ends 8 years as head of the central bank, during which he never once raised interest rates. A rate cut seems to be a done deal. The only question is whether the base rate moves from minus 0.4% to minus 0.5 or 0.6. That move is not widely seen as a good thing. Critics of ECB policy in Germany and Holland, for example, question whether further moves into negative territory might actually be counterproductive, as they make it ever harder for banks to make a profit and so limit their ability or willingness to lend to businesses and individuals. If a rate cut is a racing certainty, all eyes will then be on whether or not Draghi resumes the ECB's quantitative easing programme. It already owns 2.6 trillion euros of bonds, but could still buy more. Again, the only real question is the size of the stimulus. The consensus is that the central bank will buy bonds to the value of somewhere between 400 and 600 billion euros in the first year. That kind of move should be expected to push bond prices higher and yields lower. But last week, prices actually fell as some investors questioned whether expectations had run too far too fast. The case for further stimulus is that growth is slowing on the back of global trade tensions, which are a particular problem for Europe's engine room, Germany, a big exporter. At the same time, inflation remains weak across the Eurozone. Price growth expectations are currently around 1.2% 5 years out. That's well below the ECB's 2% target. In addition to a rate cut and more QE, there's speculation that the ECB could provide cheap loans to banks under a third targeted long-term refinancing operation. And finally, there could be a shift in the central bank's forward guidance. It could, for example, commit to not raising rates before 2020, or it could say that it will only raise rates if inflation expectations approach its target. Whatever happens on Thursday, it's quite an admission of failure that monetary policy is still trying to stimulate the economy 11 years after the financial crisis. Mr. Draghi's successor, Christine Lagarde, will have a daunting task ahead of her when she moves from the International Monetary Fund to the ECB later in the year. Now, turning back to Brexit, it's been an extraordinary week in Westminster, with not a day passing without some momentous development. These started as soon as Parliament returned from its summer recess last Tuesday, and MPs took control of the parliamentary timetable in the House to push through legislation designed to force the Prime Minister to request a further extension to the Article 50 process if he'd failed to secure a withdrawal agreement by the 19th of October. The bill was voted through and passed to the House of Lords, where, after a short-lived attempt by Brexiteer peers to block the legislative process, it was duly passed, and last night the Queen added her signature at Balmoral to pass it into law. Knowing that no deal had probably been taken off the table, Boris Johnson then threw down the gauntlet to Jeremy Corbyn, calling for a general election in the middle of October. Winning this, Johnson hoped, would allow the government to rescind the extension legislation and plough on with the proposed no-deal departure on the 31st of October. But once Labour realised that this is where we were heading, it agreed with the other opposition parties to block an early election. Under current legislation, an election outside the normal 5-year timetable requires the support of 2/3 of MPs. Last night, a second attempt to trigger the election was also voted down, the government's 6th defeat in 6 votes since Mr Johnson entered Downing Street. The votes were just the start of the drama, because in a last-ditch attempt to prevent the passing of anti-no-deal legislation, the Prime Minister had threatened to throw any rebel Tory MPs out of the party if they voted with the opposition. In the end, 21 of them did, and he was forced to eject some of the party's most senior and well-regarded parliamentarians, including Winston Churchill's grandson and 2 former chancellors. Effectively, the government's strategy was in tatters, and the Prime Minister was a captive in Downing Street, unable to deliver on his do-or-die Brexit policy. When former Home Secretary Amber Rudd decided to join the Prime Minister's brother Joe in quitting the cabinet, and in her case the party, many observers were left wondering what could possibly happen next. Well, the resignation of the Speaker of the House, John Bercow, and then the Duke of Wellington, a descendant of the Waterloo hero in the Lords, provided the final encore of this parliamentary session. With Parliament officially prorogued or suspended last night, the answer lies beyond the Houses of Parliament. The onus is on the Prime Minister to secure a deal with the EU, to accept or to ignore MPs' demand to seek an extension, to resign, or frankly any number of other options that we haven't yet thought of. We are heading towards an election, probably in November, but between then and now, who knows? So, how have investors taken this ongoing saga? Well, surprisingly well, with the pound rising to its highest level in 6 weeks against both the euro and the dollar, as investors responded to both better than feared economic data and the likelihood that the 2 most extreme outcomes, a no-deal exit or a Corbyn-led far-left government, are less likely. No deal is coming off the agenda for now anyway, thanks to MPs facing down the Prime Minister. Meanwhile, the most radical left-wing agenda since the 1970s is putting voters off Labour's leader-in-waiting. Despite Boris Johnson's disastrous week, he still leads Corbyn easily in the latest polls. On the back of data showing that the UK economy expanded by 0.3% in July, outpacing estimates of 0.1% growth, the pound traded as high as $1.2360. That's still low by historic standards, but it's well up on the $1.19 it hit last week. On the broader global stage, shares have had a reasonable time of it too, as investors started to see the global economy as glass half full. Jobs data at the end of the week in America were a bit worse than the previous month and a bit lower than forecast. But with 130,000 jobs created in July, the labour market is still expanding. Remarks from the US Central Bank helped sentiment too, with Fed Chair Jay Powell promising to act as appropriate with respect to future policy shifts. The next Fed meeting concludes next Wednesday, the 18th of September, and a further quarter-point cut in the interest rate is expected. That will build on the ECB's stimulus this week, if that's what we get, and it follows last week's move by the Bank of China to cut its required reserve ratio by 50 basis points, half a percentage point. This reduces the amount of cash that Chinese banks need to hold in reserve and should see that money find its way into the wider economy. With expectations rising of further trade negotiations between the US and China next month and a slight easing in worries about protests in Hong Kong, investors regained some of their appetite for risk, and safe havens like gold and government bonds fell off the radar. One other market received a boost this week for unrelated reasons. The oil price edged 1% higher to just over $62 a barrel after an unexpected shake-up at the heart of Saudi Arabia's government. The move to replace veteran Energy Minister Khalid Al-Falih was most surprising for the identity of his successor, Prince Abdulaziz bin Salman. He's the son of King Salman. The decision is counter to a long-standing tradition not to appoint members of the royal family to that key position. Analysts believe the reshuffle could upset the global oil market at a time when Saudi Arabia and its OPEC allies have struggled and failed to raise the oil price to a level at which the oil-rich kingdom can balance its budget. And finally, in corporate news, Apple is in the spotlight this week as it unveils the next generation of its flagship iPhone range, which accounted for nearly half of net sales in the most recent quarter. Upgrades are expected for the current high-end products in the range, the XS and the XS Max.